Hey, good day everyone. Grab a seat, make yourself comfortable. This is a presentation for the Daily FX audience entitled How to Improve the Timing of Your Trades, and to do so we are going to use moving averages. Now this presentation is going to be part PowerPoint but also part live data. See, what I don't want to do is bore you with perfect slide examples of charts from the perfect world that makes me look smart because they fit my theories just perfectly. What I'm going to outline are the strategies that I use as a professional trader each and every single day. We will go through those examples so that you understand the methodology and strategy, and then we're going to open up the live charts and apply them to what happened today and yesterday. Fair enough? And for the chart examples and for the live data, I am using the MT4 platform provided by FXCM. So here we go. Grab your hat. Let's move forward. Now, let me remind you that the purpose of this presentation is education. And in this presentation, there are no alert services, there are no trade recommendations. But fear not, my friend, this is going to help you to apply technical analysis and help you plan your trades. Now, also, it's common sense. It's simple common sense. Even a 5-year-old knows that trading and investing is risky business. However, Forex is unique because you're leveraged 100 to 1 or even quite a bit more. As an amateur trader, once in a while you may get lucky and that leverage will work for you. But look, more often than not, that leverage is going to work against you. Do not trade real money until you have a track record of success using a demo account. Now, my name is Wayne McDonald. I'm the Chief Currency Coach of FXBootcamp.com. I'm also licensed and registered by the National Futures Association as a commodities trading advisor. There's not too many of us CTAs around, but what it means is that I've passed the test, and essentially I'm an expert in fundamental analysis and global money flow and all that kind of stuff. That's what a CTA really is. And it's a license to advise professional investors like hedge funds and stuff. And I always felt, since there's so many educators and gurus out there, it seems like every other guy is an expert, but hardly any of them, almost none of them are licensed and registered to be able to advise a professional. So I scratched my head and say, well, why would an amateur take advice from them if a professional wouldn't? So anyways, I'm a commodities trading advisor and the Chief Currency Coach of FXBootcamp.com. Now, my website, FXBootcamp.com, provides live training and analysis 12 hours a day. So we watch the market move, we explain what's happening in the market, and we help traders not only understand but create trade plans in real time as the market's moving. They're not trade signals. We're teaching you how to trade on your own, how to do your own analysis, how to stand on your own 2 feet, how to make your own decisions, and how to become a professional Forex trader. A lot of the concepts and strategies and tactics that are going to be outlined in today's presentation are also clearly detailed in my book, The FX Bootcamp Guide to Strategic and Tactical Forex Trading. It's available on Amazon.com and is currently a top seller. It's usually number 1, number 2, or number 3, depending on the time of day you log in. In any case, let's move on. Moving averages. This is what we're going to use today to time our trades. Very, very important stuff. Okay, they are lagging. Okay, they're not going to tell you what's going to happen in the future. Okay, they're not a crystal ball, but they do tell you important information. They tell you what has happened. Now, the past doesn't always predict the future, but the past is important. Okay, so they do lag. However, because you can measure what has happened, you have a reasonable assurity of what could happen in the near future, and that's called a trade plan, right? So what we're going to do is look at the moving averages, see how they described what has happened. We're going to be able to then differentiate the difference between price action and market action, which is really, really important. Okay? Again, we're going to differentiate between market action, the overall market forces, let's say, of the day, and then we're going to look at price action, which is what's happening in the moment. So they're looking at the same price and time data, but at two different points of view, and I'll show you if you can line them up, you have a better chance of success. Now, before we go any farther, you're going to have to understand what my charts look like and what they mean, okay? What I look at, first of all, is speed of the market. That's the market action. I use 2155 EMAs. Remember, we're using moving averages, all right? I use 2155. You can use 2060. Honestly, it doesn't matter. Don't get hooked on looking for a magic formula, okay? I'm just using medium-term moving averages. I like 2155. Now, for price action, or what I call momentum, we look at the 5-8 EMA, and the 8 is an SMA, but again, you don't have to get too focused on that. It doesn't really matter. I'm using short-term moving averages. That's all that matters. They cross a lot because they're measuring things in the short term. For trend, I use 200 EMA. We're not going to talk about that today. For volatility, I use Bollinger Bands at 2 standard deviations. Again, we're not really going to talk about that today. And for oscillators, I use MACD set at 2155.8 and stochastic set at 835. Now again, we're not going to talk about those today. What we are going to talk about is how to align up price action with market action using these moving averages. Now notice how my the common thread or the common denominator between all my chart setups and all my indicator setups are Fibonacci numbers. So there is some sort of divine harmony in here, but you can, again, just find what works for you, and that's, keep doing that. So let's talk about what these look like. Now, the first thing that we're going to look at is market action, okay? And the orange line and the blue line, all right? The orange line is a 21 EMA, and the blue line is a 55 EMA. Again, what this represents is market action. Now, because they're medium-term moving averages, let's say you're looking at a 15-minute chart. In fact, you are looking at a 15-minute chart. It looks like a pound-dollar 15-minute. They don't cross that often. They're medium-term. They're really slow, okay? Again, the 21 EMA is showing you a moving average of 21 candles, and the 55 EMA is a moving average of 55 candles. So you know what? On some days, you'll find that this may only cross once or twice, okay, which is great. I use the 2155 if I'm swing trading. See, ideally, you can get in near the top of the market, ride it all day, and then get out at the bottom of the market. Well, that's where, literally, if you're getting in at the top and out at the bottom, that's the market, right? That's what you're trading, the market. You don't need to be concerned with price in that situation, that you're trading the market. So that's how I measure market action. And now price action, remember, it's short term. I call it momentum, in the moment. What is price doing now? And for that, I use the 5 EMA and 8 SMA. And you can see they cross a lot more, don't they? They cross a lot more all the time. They cross constantly, right? But that's what happens with price. Now, if I back up again, here's a 2155 cross. Here's a 2155 cross. It doesn't happen very often, right? See, that's what's powerful about the market. It shows you direction if you use it right. Now, how many times have you seen, like, let's say the market falls, like in this example? Okay, the market falls. Let's say, somebody asks you, hey, so how did trading go? And you said, well, the dollar fell today. Yeah, but you know what? When the market falls, we know that the definition of a falling market is a series of lower lows, lower highs, lower low, lower high, lower low, lower high, lower low, lower high, on and on and on, right? So even if the market is down, right, if the market is down, price can still go up. In fact, price goes up all the time in a down market. So that's why I want to separate the two. Measure what's happening in the market, and perhaps I can make a decision on what I want to do throughout the day. See, that decision is called a trade plan. What if the market's falling based on what I see the 2155 doing? Early in the day, I could say, well, look, the market is down, so I want to look for reasons to short. Well, what's a reason to short? Well, how about pull the trigger and sell the currency pair every time price moves to the downside. That's the whole premise of what I'm showing you. Remember, I'm going to show you live charts in a little bit. Okay, so that's what my chart looks like on any given day. There's my oscillators down here and all that kind of stuff, and then there's that trend I talked about. But the bottom line, when you put it all together, it looks like a lot of lines, but it's not. Okay, you're seeing this for the first time, so you might say, "Oh my goodness, Wayne, look at all these lines." Well, you know what? That's not what I'm looking at. The first thing I look at is the 2155 cross. And I say, technically speaking, the market is down now, so I want to look for reasons to short. Okay, and let me show you how to do all of this. Okay, now a couple of things here. When it comes to price and market action, we are using moving averages, right? Now, the steeper the angle and the wider the separation between the two moving averages, whether it's price action or market action, doesn't matter. The angle and separation of the two moving averages, the greater it is and the steeper it is, shows stronger. Okay, so again, if the 5/8 is dropping straight down, there's a good separation between the moving averages. You should be confident in the moment that price is falling, and well, you certainly don't want to go long when price is falling. Now, when you see a lot of crossing of the moving averages, that's called braiding. You know, like a girl's hair, one crosses over, and another over, and another over, and another over, and another over, cross, 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 cross. That's a sign of either weak momentum or a weak market. You don't know what's going on. You have no direction, no nothing, no momentum. That's your opportunity to do two things: either lose money or not trade. Okay, let's see if I go back. Okay, so for example, in here, you know, there's not a lot going on, right? As compared to down in here, we got nice angle and separation between the 2155. So the market's falling, and it's falling quickly, and you should be confident in shorting. And then, of course, like the angle and separation here between the 5/8. You should be shorting, and you should be confident in staying short. You certainly wouldn't be thinking long. So that's what that's all about. Okay, so what you're looking for is powerful market action. Okay, good angle and separation between the 2155 to set you up for the day. You're like, aha, the market is up today, I want to buy. Or you say, aha, Zeus. All right, the market's down, I want to look for reasons to short. And then once you have that established, which is a trade plan, then you look for reasons. Okay, so you look for things like 5/8 crosses, momentum of price in the same direction of the powerful market forces. That's your best. Now, also when you're in the short term, you see things like support and resistance in your way, and then you say, oh well, I don't know if it's going to break. Well, see, that's where it's key to really reading your charts. If you have strong momentum, right, good angle and separation between the 5/8, you're likely to break those support and resistance lines, and you just keep going in the direction the market wants you to. But if you have weak, let's say the 5/8 is crossing a lot, right? And you're up against support and you're losing angle and separation between the 2155. You know what? You're not going to break support. It's going to hold and possibly reverse. You should at least recognize that and adapt. Okay? Okay? So again, market action. What we're looking at is speed of the market. We use a medium-term moving averages. And what you're also asking is, based on the 2155, are we range-bound? If we're range-bound, you're probably going to see things like the 2155 crossing a lot. That means you're range-bound. Now, if you're a scalper, what you can do is then identify support and resistance and, you know, sell at the top and buy at support and sell at resistance and buy at support. That's tricky. You have to be an advanced trader for that. If a conservative trader would say, wow, we're range bound, there's no trend, there's no market direction, there's no nothing, I'm not going to do anything, I'm going to sit on my hands and not lose money. Okay? Now, if the market is trending, so you have, let's say, a good cross like this, and you have good angle and separation to the upside, then yeah, you know what? Then you want to get on that trend and ride it as far as you can. Okay? And price action, again, measure of price. Short-term moving averages, I like the 5/8, you can use 3/5, 8/13, whatever. And then, of course, you're using this to understand, are we going to break out of a range, are we going to break through support resistance, and of course we're using the 5/8 cross to get into the same direction as the 2155 cross. And what we're doing is aligning price action with market action for the best probability of success. Okay, you can trade against the market, but it's not as good as trading with the market. Okay, so let's go to the live charts. Yeah, baby. Let's go to the live charts. What you're looking at here is the pound dollar. This is live. You're looking at the MT4 charts provided by FXCM. You know, the prices are moving. This is the real deal. This is happening right now. On the left, I have a 15-minute chart. In the middle, I have a 1-minute chart. On the right, I have a 1-hour chart with pivot points. And let's stick to the 15-minute chart right now. Again, this is the pound dollar. And what's the first thing I look for? I say to myself, Wayne, what direction is the market today? Well, look, over here we have a 2155 cross. It looks like it happened yesterday or so. Nice, 2155 cross to the downside. The 21 is below the 55. Technically speaking, the market is down. Fantastic. So what do I do with this information? Well, ideally now, what I try to do is line up price action in the same direction as the market. So the market's down, so I'm looking for reasons to short. Well, how do I determine that? Well, how about things like, how about a 5-8 cross to the downside? Remember, price in the moment. All right, so how about in here? Almost got a 2155 cross to the upside. The reason it didn't cross up is look at that trend. We didn't cover it today, but the trend also has been pulled from neutral to down. So in any case, we get a downward action. Price waits for the moving averages to catch up, and then all of a sudden it kicks down again. So anyways, here we're getting a greater angle and separation between the 2155. What does that mean? Well, the market's falling again and it's picking up its pace. All right. So in here, when it's really, really narrow, it's less ideal because of the diminished angled separation between the 2155, and then it picks up again. So once you are confident that now the market is falling in the same direction as trend, now what you want to do is take, how about 5-8 crosses to the downside on this? How many times does it cross? Well, crossed here, there's your opportunity to short. It crossed here, okay, actually let me draw this differently so it's easier to see. Okay, there's an obvious cross, all right? Here's an obvious 5-8 cross. Here's an obvious 5-8 cross. Here is an obvious 5-8 cross. Here is an obvious 5-8 cross. Sorry, these are terrible arrows. And then all of a sudden in here, we're getting all kinds of crossing and braiding. And this is probably your sign right now to maybe take some profit off the table, that things are maybe going to change. And the reason for it is it's 7:45 in the morning right now, and so New York's coming online pretty soon, and maybe they're cashing out some of their profits as well, waiting for potential news today. Also, what you don't see here is the reason that price is wimping out is we're on the weekly S2 reversal pivot point in here, and it's that S2 weekly pivot point is something that hedge fund managers use. So a lot of pressure to the downside here, and this is a logical place for people to take some profit. So that's why you see it wimping out. But the most important thing is right in here, you know the market's going to fall. You know it. That's what it means, the great angle and separation. So whether you traded here, here, or here, let's say you got in this really late, okay? I mean, these are 15-minute candles. Let's say you're a half a day late getting in onto this. At this point here in time, okay, you can see the 2155 is way below the trend, okay? The market is falling, and it's falling quickly. Look at the angle and separation between the 2155. Are you nervous that they're going to cross up? They're not even remotely close to each other, and they haven't been for a half a day or so. There is good angle and great separation between the two market measuring moving averages. You're like, holy moly, this thing's falling. It's falling fast. I'm confident it's going to continue falling. I need opportunities to sell when price action is falling as well. Very simple. test of the 21 and then a 5-8 cross to the downside, you could easily have shorted there. Okay, down she falls. Maybe there's another opportunity to sell. Here's another opportunity to sell. These are just 5-8 crosses. Never once were you nervous about the 2155. In fact, it started falling faster and faster and faster. Greater angle and greater separation should make you even more confident of shorting. And then right here, guess what happens? For the first time in days, guess what? We didn't make a lower low. Take your profit off the table. Okay, so even if you're in late here, you're in around 169.5, and you're cashing out for profit at, let's say, 162.5. All right, not bad. From 69.5 to 61.5, and it only took one night. Hey, not too bad. Okay, and it all started with there. So there's the pound dollar for you. How about, what do we want to do now? How about pound yen? People love trading that. See, the yen is strong right now and the dollar is strong right now, so that's why you're getting these big moves. And why am I picking on the dollar, the pound dollar and the pound yen? Well, like I said, the yen is strong right now and the USD is strong right now based on global money flow and all this kind of stuff, whatever. And the pound happens to be weak. So if you were trading in the last few days, you should have been short both these pairs. So anyways, look at this. It almost looks like the same chart, right? I kid you not. This is the pound yen 15-minute chart. It is a different chart. All right, 2155 cross there means technically the market is to the downside. It's falling. Price makes a new lower low, breaks out of its previous range, which is somewhere in here, comes back, retests support, old support, now becomes resistance, plus the moving averages move below the 200 EMA, which is the trend. And just like last time, right in here, the market begins to fall again, and angle and separation between the 2155 increases. So what are we trying to do now? Technically speaking, the market is falling. What's our goal? What's our trade plan? Short every time price action falls as well. So how do we know price actions to the downside? 5-8 cross, 5-8 cross, 5-8 cross, 5-8 cross, 5-8 cross. Which one do you want, right? And how do you know to get out? Look at this. Here's a new lower low. Here's a double bottom. Here's a triple bottom. What happened to the series of lower lows and lower highs and lower lows and lower highs and lower lows and lower highs that the 5-8 cross is giving us? And then all of a sudden we get down here and all of a sudden no lower lows. What's happening? It's wimping out. Why? Again, on the weekly pivot point chart, that's a support pivot, and that's where hedge fund managers are cashing out. And so New York's about to start. Maybe we'll have a new change in direction, or maybe this is going to make a new lower low once we get some new traders in. I don't know. But again, start with the market, right? What direction is the market going? Once you have that established, once you have direction established in the market, then all you have to do is trade in that same direction using price action. So let me pull that PowerPoint presentation back up. There you go. So in summary, what we're looking for is steep angle and separation between the moving averages. Doesn't matter whether we're measuring price action or market action. The greater the angle and the greater the separation, the greater your confidence should be. Now, once again, braiding lots of crosses, the 5-8 crossing, 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 crossing. And you'll see that in between the markets, let's say at the close of the New York session, but before Asia opens, you'll get all this kind of braiding. That means there's no momentum whatsoever. You shouldn't be trading. And for higher probability, the takeaway from this presentation is what you're trying to do is establish market direction first and then line up with price action. It's not a guarantee to success. I want you to open up a demo account and practice these theories, the strategy on your demo account until you get comfortable measuring both the direction of price and momentum, the direction of market, and then lining up price momentum with it. But just logically speaking, price, just like water, wants to find the path of least resistance. So don't trade against the market, trade with the market. And once again, my name is Wayne McDonald, Chief Currency of FXBootcamp.com. Thank you for attending this presentation on Daily FX.